Germany, the economic powerhouse of Europe, is facing strong headwinds. The once mighty export engine is sputtering. High energy costs are taking a toll. Weak domestic demand adds to the problem. Global uncertainty further clouds the outlook. Is this a temporary blip or a sign of a deeper crisis? Germany has long been a bastion of economic stability and growth. Its manufacturing prowess, skilled workforce, and commitment to fiscal prudence have been the envy of many. However, the current economic climate presents a unique set of challenges that threaten to derail its economic progress. The confluence of internal and external factors has created a perfect storm that could have far-reaching consequences for Germany and the wider Eurozone. High energy costs, driven by geopolitical tensions and supply chain disruptions, are squeezing businesses and consumers alike. The once reliable flow of affordable energy from Russia has been severely curtailed, forcing Germany to seek alternative sources at a premium. This has led to a surge in energy prices, eroding consumer purchasing power, and increasing production costs for businesses. Adding to the woes is weak domestic demand. German consumers, known for their frugality, are tightening their purse strings in the face of economic uncertainty. This reluctance to spend is further dampening economic activity. Businesses facing declining sales and rising input costs are hesitant to invest and expand, creating a vicious cycle of low growth and weak demand. The global economic outlook remains uncertain, with geopolitical tensions, rising inflation, and the lingering effects of the pandemic weighing on growth prospects. This uncertainty is impacting Germany's export-oriented economy, as demand from key trading partners weakens. The slowdown in global trade is further exacerbating Germany's economic woes. The coming months will be crucial for Germany's economic future. The government's response to these challenges will determine whether the country can navigate this difficult period and emerge stronger, or whether it will succumb to a prolonged period of economic stagnation. Bold and decisive action is needed to address the structural issues hindering growth, restore business and consumer confidence, and secure Germany's economic future. Germany's GDP growth has slowed to a crawl. In 2023, the economy grew by a meager 0.3%. Forecasts for 2024 are equally grim, with projections hovering around 0.5%. This sluggish growth reflects both structural and cyclical challenges. The German economy, heavily reliant on manufacturing, is facing headwinds from global competition and technological shifts. The automotive industry, a cornerstone of German manufacturing, is grappling with the transition to electric vehicles, which requires significant investments and job retraining. The slowdown in global trade further exacerbates these challenges, as demand for German exports weakens. The cyclical factors weighing on growth include high energy prices, weak domestic demand, and supply chain disruptions. These factors are interconnected and feed into a vicious cycle of low growth and weak sentiment. High energy costs erode consumer purchasing power and increase production costs for businesses, leading to lower investment and job creation. The slowdown in industrial output is a major concern. German factories, once humming with activity, are facing declining orders and production cuts. The automotive sector in particular has been hit hard, with major manufacturers announcing layoffs and production halts. The weakness in industrial output is a drag on overall economic growth and a sign of deeper structural issues. The slowdown in exports, another key driver of German economic growth, is adding to the woes. German businesses are facing declining demand from key trading partners, particularly in Asia and North America. The global economic slowdown, coupled with geopolitical tensions and trade disputes, is weighing on global trade, impacting Germany's export-oriented economy. After years of low unemployment, Germany is witnessing a worrying trend. The unemployment rate, which stood at a low of 2.8% in 2023, is projected to rise to 3.2% in 2024. This uptick in unemployment is a direct consequence of the economic slowdown and highlights the human cost of economic stagnation. The manufacturing sector, particularly the automotive industry, is bearing the brunt of job losses. As car makers grapple with the transition to electric vehicles and declining global demand, they are being forced to cut jobs and restructure their operations. This is leading to significant job losses in regions heavily reliant on the automotive industry. The transition to green technologies, while essential for long-term sustainability, is also contributing to job losses in the short term. As Germany phases out fossil fuels and invests in renewable energy sources, jobs in traditional energy sectors are being displaced. While new jobs are being created in the renewable energy sector, the transition is not seamless, and there is a mismatch between the skills required for these new jobs and the skills possessed by workers laid off from traditional energy sectors. The rise in unemployment has social and economic consequences. It leads to lower consumer spending, increased demand for social welfare programs, and a decline in tax revenues, putting a strain on government finances. Moreover, long-term unemployment can lead to skills erosion and reduce the potential for future economic growth. Section 4. Interest rates and their impact, a delicate balancing act. The European Central Bank has been grappling with the challenge of taming inflation without exacerbating the economic slowdown. The ECB raised interest rates throughout 2023 in a bid to curb inflation, which soared due to high energy prices and supply chain disruptions. However, these rate hikes have increased borrowing costs for businesses and consumers, potentially further dampening economic activity. The ECB's rate hikes have made it more expensive for businesses to invest and expand, potentially hindering economic growth. Higher borrowing costs also discourage consumers from taking out loans for big-ticket purchases like homes and cars, further weakening domestic demand. There is growing speculation that the ECB may cut interest rates in 2024 if the economic slowdown worsens. Lower interest rates could provide some relief to businesses and consumers by reducing borrowing costs and stimulating economic activity. However, the ECB must tread carefully, as cutting rates too soon could reignite inflation, which, while moderating, remains above the ECB's target of 2%. Section 5. Inflation persists, eroding purchasing power and confidence. Inflation has been a major concern for Germany, eroding consumer purchasing power and fueling economic uncertainty. In 2023, inflation averaged 6.5%, significantly higher than the ECB's target of 2%. While inflation has moderated somewhat in 2024, it remains elevated, with projections hovering around 4%. High energy prices, driven by geopolitical tensions and supply chain disruptions, have been a major driver of inflation. Russia's invasion of Ukraine sent shockwaves through global energy markets, leading to a surge in oil and gas prices. This has had a ripple effect throughout the German economy, increasing production costs for businesses and pushing up consumer prices for everything from groceries to transportation. Supply chain disruptions, exacerbated by the pandemic and geopolitical events, have also contributed to inflation. Lockdowns in China, a major manufacturing hub, and disruptions to global shipping routes have led to shortages of raw materials and finished goods, pushing up prices. While energy prices have moderated somewhat from their peaks, core inflation, which excludes volatile energy and food prices, remains stubbornly high. This suggests that inflationary pressures are becoming more broad-based, with businesses passing on higher input costs to consumers.